You must understand the concept of money as debt. Yes, that's right. The money you use today, it's debt. My name is David Quinteri, and I have been looking into this information that's so complex and convoluted for well over a decade. And what I do is I take all of that and make it real simple. I make these videos so that you don't have to spend those hours a day looking into all this information. You simply just watch and learn. Money, as we all know, is a medium of exchange, a unit of account, and a store of value. It wasn't always this way though. Our ancestors traded through barter, which eventually evolved into our current money system. But things aren't as simple as they seem. All of this I've outlined in my books. I also have several videos. If you go to my YouTube channel, scroll down to the bottom, there's a lot down there. But of course, there is this concept of money as debt that I don't think a lot of people understand. And of course, it can be complicated, but I'll tell you in a simple way. Debt, on the other hand, is an obligation, something that you owe. You borrow money now to be paid back later, often with interest. Debt itself isn't a bad thing. It's how we buy houses, start businesses, and fund education. But what happens when the money you borrow isn't actually there? Some people might be saying, sorry, what did you say? What are you talking about? Now, let's bring banks into the picture. Banks are not just money vaults. They are, in fact, money creators. And this brings us to the concept of fractional reserve banking. When a bank gives out a loan, so you go to the bank, you go to get your mortgage, you're getting a loan. You would think like as if they have money in a vault and they're going to go and hand that over to you or hand that over to the seller of that home. It's not handing out someone else's deposits. Instead, it's creating new money out of thin air. This concept, like even still today, it just boggles my mind how this was ever allowed. But that's the way it goes. You got to understand, you've got your central banks at the top, then you've got your commercial banks underneath that, and then you have you at the bottom. These are the three layers, and they're all working kind of synergistically together. The borrowers are the ones paying back in with interest, creating more and more and more on top of this system. Fractional reserve banking means that when you deposit money into a bank, it's not just sitting there. In fact, it really isn't sitting there. You know that when you go call them up, or when you say, basically you walk in and say, hey, I need some money. They tell you, oh, you didn't call us 7 days in advance to get that 3,000? Oh no, we don't have it. The bank only keeps a fraction of it and lends out the rest, creating more money. Sounds efficient, right? Well, let's go deeper into that. Central banks like the Federal Reserve in the US or the ECB, the European Central Bank in Europe, regulate the process. They set reserve requirements and interest rates, aiming to control inflation and stabilize the economy. But this control is indirect, and sometimes it's just not enough. By the way, in the case of China, they're going in the opposite direction. They're actually loosening. Instead of restricting, right now they have been loosening. Why? Because they want more borrowing. Their economy is starting to slow down. The growth just isn't there. So they're trying to stimulate. So you can see what the central banks will do as they move through a cycle. Debt does stimulate economic growth. Businesses expand, jobs are created, people can buy homes. But it's a double-edged sword. The same borrowing that stimulates the economy can also lead to excesses and crashes. And that's where we start to see the cracks in the system. We saw that during the financial crisis. We saw that in so many of these other cycles that generally don't end well because of the excess. The debt-based money system is like a seesaw. On one side, it brings growth and liquidity. On the other, it can cause inflation, financial crisis, and potential for over-leveraging. The risks are too great to ignore. That's why we should always be taking a look at how much debt there is and what is the borrowing cost. Like, what are interest rates right now? If you see this, people are borrowing more than they ever did. And the rates for so many people have never borrowed at these levels. because rates had been so low for so long. So they're programmed to believe that they'll stay there forever. But that's not the case. What makes this even more volatile are debt cycles, both the shorter business cycles and the long-term debt cycles that can result in severe economic downturns when left unchecked. We've seen this happen time and time again. Right now, we're going through one. It's a painful one for a lot of people. Is there a better way? Some suggest the full reserve banking, where the banks only lend what they have in reserves. There's also the emerging world of cryptocurrencies, free from the control of central banks. There's a limitation, for instance, Bitcoin, only 21 million Bitcoins ever. And then, of course, you factor in all those which have been burned, never going to come back. It's much less than 21 million. And so people say that's the proper system. That's how it should be. It should be finite. Of course, you've got the classics, the way that the Constitution was designed with gold. People love silver as well. We've seen gold and silver being used as reserve currencies before, or the most prominent currencies before. We've gone a long way from that, let me tell you. While not without their own challenges, these alternatives could mitigate some of the systemic risk that we currently face. We've got to understand money as debt, because it changes how we look at our current economic system. It raises questions. Who's in control? What's happening for us to actually get to this point? Many distractions in politics and the celebrity world that actually will keep us from digging into the truth. People they just don't want to spend that time. But I'm glad you're here. I'm glad you stayed with me. So that's what we have. A system based on debt, money created out of thin air. You watch those magicians and they pull the rabbit out of a hat. That's what these banks are doing, your commercial banks. And this is being allowed, the system, because of the central banks. The central banks are dictating that. And so we can see that everything's all fine and dandy as long as people can pay back. But when you see the delinquencies rise or too much debt, and people simply get to a point where they can't take any more, and then we have a deleveraging process where people start going bankrupt, they have to cut back on their spending, economic slowdown, and so on. This is money as debt. I hope you appreciate this video. If you did, share it with somebody that you know. Put it on your Facebook, on your Twitter, and please give it a thumbs up, because that helps people you don't know understand that this is a good video that they should watch. I'll see you on the next one. Take care.